Hello and welcome to the Extraordinary Retirement Podcast with your hosts, Gregg Indovina and Nate Yeomans. I'm Wendy McConnell. I just love to see the big smiles on your faces when I come on.
Yes. Hi, Wendy. It's great to see you.
Good to see
Nate's
you too.
excited because we're going to be talking about real estate.
I enjoy real estate. It can be a fun topic to talk about. A lot to unpack there for sure.
Real estate magnate.
Oh, I got the joke there. I like that. Well played, Wendy. Well played.
Well, we're specifically going to be talking about the role of real estate in a person's retirement plan.
Yeah, there's a lot of different forms that can take, right? You know, whether it's how do you use a home equity line of credit in a real estate plan? What role does that play to reverse mortgages? All the way to what if you have current investment properties that are producing income for you? But there's more than, physical ways to own real estate as well. And so we're going to get into some of the different dynamics there. And because we know that there's a lot of people that own real estate and they're trying to figure out, okay, how does this fit into my retirement plan? And is it something that I want to keep long term? Or do I want to go a different direction? And what does that look like if I decide to try to sell this property? Maybe I've owned it for a long time. And so, like I said, there's a lot to unpack here. We're probably not going to be able to get through all the ins and outs of real estate today, but let's kind of dive in.
Yeah, let me start by saying this. The default for people that don't have good retirement planning, typically by the time they retire, their house is either paid off or close to being paid off. That's usually one of their goals, but
right.
That's the first thing. But they never really use it in their plan in any way, shape, or form. They have all of this equity in the walls of their home, and they just live their life, and then at the end of their life, the house goes to the kids. Right? That's the default setting for most people, and we're going to show you a lot more creative approaches around that. So Nate, you want to just kick off the pros and cons of real estate in retirement? You want to do the pros?
Yeah, let's dive in. So the first thing is that obviously any investment property, so think rental, the whole idea there is you're producing a passive stream of income, right? And I say passive, I mean relatively, if you're managing that property and you're dealing with toilets, tenants, and trash, and having to oversee the management of that property, there's certainly work there. But, if you have an investment property that's producing X amount of income per month, then that becomes a nice steady stream that you don't have to take from other investment portfolios. And so that is certainly a pro. The other pros are the property has the ability to appreciate. So one thing that I do like about real estate is while the value of the real estate is hopefully going up in value long term, and like most investments from a long-term perspective, we'll see continued increase in value of that property. While it's going up in value, it's paying you at the same time. So that's a good combination, right? Is that when you're getting an income stream and it's going up in value over time. Along the way, though, and this is one of the unique things about real estate, is it also can provide unique tax benefits. So while you own that property, you do have certain abilities to write off that property or to depreciate that property. For some that have owned it for a long time, they might have fully taken advantage of all of those tax benefits. But if it's still a relatively new investment, you're still getting tax benefits along the way. So let's compound that again. We've got a property that's appreciating in value, paying us income, and we're getting tax write-offs at the same time. So that starts to become a pretty powerful aspect of a retirement plan. Real estate can also be a good hedge to inflation. And here's why, is that if we've been dealing with inflation, right, and seeing it at higher levels than what we historically have for quite a while. But as inflation increases, so does generally the price of rent at generally a similar pace. And so what happens is that cash flow that income stream can go up with inflation, and that helps you keep up with inflation. The fifth way that this is a pro is it's a true diversifier. Okay, owning real estate, especially in the brick and mortar fashion of this is a tangible asset that you physically own, is very different than owning investments inside the stock market. right? It's completely not correlated to the stock market, and it's its own asset class by itself, and so it can be a really good diversifier to balance out a retirement investment portfolio. And then the last way is that how do you leverage opportunities? And Greg was alluding to this a little bit earlier, is that, essentially if you have an investment property that maybe you've been renting for a long time. So imagine somebody else has been paying that and creating that equity for you. So you're using other people's money. So that's a form of leverage, is you're using someone else's rent dollars to pay down the asset for you. But over time, are there other ways that you can tap into that equity to use it into retirement? And so there's just multiple different ways that this could be a potential pro in a retirement plan. But like anything, like we said, there's pros and cons. So Greg, what do some of those cons look like that you see on the real estate side?
Yeah, the first one are just the liquidity issue. It's not like you can go and raise cash by selling a house and then buy your house back a couple of days later like you can with paper assets. It's very hard to convert into cash versus some other things that you can do. Market volatility. The price of homes and other real estate investments go up and down. One of the good things, though, one of the pros of this particular con is that you don't see the price of your home every day like you do your stock portfolio. Right. So you're not really quite aware of those fluctuations, but it does fluctuate. And I will add one here, and that is that the prices of real estate are overextended and overvalued at this point historically. So that's another con of buying real estate at these elevated prices. Makes you more prone to market volatility to the downside.
Does that mean that you think prices will fall at some point?
Historically, they don't. We did have a time after 2008 where prices did fall, but we are, that was the first real estate bubble. We're now in the second real estate bubble that has far eclipsed where we were during the first real estate bubble that peaked around 2007 or so. We are much, much, much higher. There's other factors, though, that we don't really have time to get into that.
Yeah, I think you got to, since we're on that topic real quick, I think we've got to think about supply and demand. That's probably one of your key drivers there is that when you have more housing supply than there is demand for that housing, as far as ownership goes, that's when we typically see the value going down. But we also have to think about affordability of those homes as well. And so as we see in a rising interest rate environment, if we go to the bank and we're getting qualified for a loan, when the interest rates were 2% versus 6%, the amount of house you can buy changes dramatically in the bank size. And so as the interest rates go up, homes become less affordable. And if somebody wants to sell that home and there's less qualified buyers to do it, that could create pricing fluctuations as well. But it really generally comes back to a supply and demand issue when it comes to real estate. And, it depends on who you talk to about that, but there's still more demand than there is supply currently.
Yeah. And a couple other things on the con side, things just to consider: ongoing maintenance costs, repairs, and your property taxes. Your property taxes go up over time based on the value of your home, and assessments and insurance can continue to climb. So those expenses don't go away even when the home is paid for. Just the burden of managing a rental property, as Nate was alluding to, with
toilets, tenants, and trash.
Toilets, tenants, and trash. Yeah. And if you do that on your own, that can be very burdensome. It also is a cost if you outsource that to some sort of management firm, management team. And then finally, although real estate is great, you can actually be overly reliant on real estate, and that could limit diversification. Just from a concentration standpoint, if you have too much real estate, that can cause some problems also.
Well, I think that, if we're to just look at the pros and the cons, we got to remember that real estate is no different than any other investment of what we would talk about in the stock market from a perspective of this is a long-term investment. meaning that you're going to go through periods of time to where market values of real estate go up and goes down. But the way that you win long term is you have the ability to use leverage. So you're using other people's money to pay down that asset for you. And probably one of my favorite things is that, you know, while that property is growing in value and it should be paying you more than what you're paying for it. So that was what we would call positive cash flow, is that it's increasing in value and you're getting tax advantages along the way. And the best part is that when you're done with that property one day and it's paid you all this income, it's provided you tax benefits, et cetera, you always have the ability to sell it, right?
Or exchange it.
Or exchange it through, you know, different ways called 1031 tax exchanges to another investment property if you want to stay in real estate. So, you know, it is this, I guess unpacking what I like about it is it can be an asset that you're using other people's money to pay for. It appreciates long-term, generally to the upside, and provides tax benefits along the way. But when you're done with it, then you have the underlying value of that asset that you can sell and turn into cash to do something else for you in your retirement plan.
The other people's money is not just the other people paying the rent, but it's borrowing money at a fixed rate and then paying it off with inflated dollars out into the future, which is why year one, your mortgage seems like, how are we ever going to make this? And then after 10 years, like, it's not that bad anymore. And then after 20 years, it's like, wow. Like I told Nate the other day, my dad's first mortgage was $140 a month. And he was afraid to tell his parents that he is, you know, that exposed. Now, 20 years later, he was that $140 was probably nothing.
The bargain.
That example kind of shows inflation as well.
Yeah, it's a little bit.
So Nate, we you know, a typical person that we work with has a home that's either close to being paid off or already is paid off, and they have all this equity, this money in the walls of their home that's not being used at all. So once you kick that off of the first thing that you can do to tap into the value of the home to improve your retirement.
Okay, so let's shift our gears a little bit here in our thinking is that now we're not talking necessarily an investment property, but your own personal property. And this is an area where a lot of people miss how can we use this as a strategic tool in retirement. Okay, and we teach this in our class, our retirement class, and we talk about what do you have that is would create a war chest for you. So think of, okay, I am retired, and now all of a sudden life has thrown me some level of a curveball, and unfortunately, in the world that we live in today, is it's probably not a matter of if, it's a matter of when, that somehow, some way we get thrown a curveball that everything doesn't go exactly the way that we plan. And so what we look for is what are the access points that you have to liquidity or to cash to be able to help you navigate through those times to manage that curveball so it doesn't completely derail you and throw you off track. And unfortunately, a lot of times when these curveballs get thrown, it happens to be at the same time that maybe the stock market's down and not doing great, and which is the worst time that you want to have to take extra money out of your retirement that you weren't, planning on taking. And so having a home equity line of credit as a strategic tool, and I stress strategic, right? You've got to be disciplined. This is not for frivolous expenses or vacations or other types of things, but having an established home equity line of credit that is an available resource that if you're in a pinch and you've got to get access to quick cash, do you have the ability to tap into the value of your home? Okay. And so that can be a really nice tool to help somebody navigate some of those curveballs that I was referring to. And then obviously you got to work on a plan to maybe start saying, okay, once I get through this, then I can work on how do I repay that over time, because you are going to be responsible for a payment of that home equity line of credit.
We kind of call this, you mentioned it as having a war chest, and your war chest can be cash on the sidelines, et cetera, but it can also be the value in your home. So the example that Nate is outlining is, let's say you're in retirement and you're taking 5% on your portfolio in a year, and the stock market, your portfolio is down, say 15%. It's a bad year. Well, recovering from 15% is one thing, but recovering from 20%, which would be if you took an additional 5 out, is exponentially more difficult.
Right.
And so we want to interrupt that by not taking additional distributions from a portfolio when it's in a downturn, because mathematically it's more difficult to climb back out of that hole, and you can run into a lot of troubles. And tapping in for a period of time into your home equity line of credit can do that. As your portfolio recovers, then you can replenish that money back into your home.
Yeah, it could be a great strategy, but again, you've got to be disciplined. This is not for somebody that is going to recklessly tap into the value of their home to use it on things that aren't true needs at a time that life is throwing you a curveball. So some of the other cons, besides, you have full access to this money, that you could use, but you got to keep it also in mind that the interest rates are generally variable. So, as you withdraw that money and you need to take that, pay that money back, just know that interest rate can fluctuate. And so we've seen a rising interest rate environment recently. And so that obviously something like that could impact you, which could cause your payments on that to go up. So it's always something to think through. Now, when I refer to payments, that means if you it's like a credit card. If you withdraw on your home equity line of credit, that means that there's now going to be a new payment that you're going to have to pay back. And if you don't pay it back, what happens, Greg?
They come get your house.
Yeah. So just know that this is not a forgivable loan, or a loan that doesn't have a repayment or a recourse action if you don't make payments on it. So again, this is just a responsible strategic tool that you use in emergency type situations. What else, Greg? How else can we use a house strategically in a retirement plan that sometimes people don't think about?
Yeah, so the value, the equity in your home versus via a home equity line of credit, you take that money out and then you owe it back into the home, plus the bank keeps interest. Another approach is a reverse mortgage, where you're actually taking equity out of the home to spend, and it's just reducing the value of the equity in the home. Now, Nate, why don't you just talk about kind of the history of reverse mortgages and some of the shadiness of previous products and offerings, and how regulators have really made these products much, much, much better.
Yeah, I mean, I think that reverse mortgages, whenever I say the word, sometimes it comes with a stigma attached to it, right? And we're seeing a lot of commercials about them today. They're being advertised.
Yeah.
And one of the general comments that I get if we bring this up, whether it's in class or it's in a planning meeting, is they say, well, I don't want to give up ownership of my home. And so obviously some of this stigma was probably created for good reason, because the original products that were designed were maybe not in the best interest of the client, to where they were losing potentially ownership of their home if they were using a product that wasn't structured properly. And there's a lot of these dynamics in there that kind of left people with a bad taste in their mouth. And it was also generally thought of as you're broke. And that means this is your last resort and you have no other choice. And while some of that is true, and that still can be there for that reason, if you do run out of money, it gives you a source. But there's other strategic ways I think that you can use a reverse mortgage today. And so what I would say is that, one, they are very heavily regulated products today. You do not lose ownership of your home. Okay. And so if you were to pass away and you have a reverse mortgage, that house stays in your estate. Now, it is expected, and this is important, that and you've always got to look at the fine print in reverse mortgages, but most reverse mortgages that I've ever seen is that when you pass away, it is expected that that house is to be sold. So, for example, is that if you have a reverse mortgage, you pass away, and the kids say, you know what, I don't really want to sell the house. I just want to kind of hang on to it for a period of time. And then I'll make that decision later, or turn it into a rental property. They're not going to be allowed to do that. They're going to need to sell the house as a part of the agreement with the reverse mortgage company. So with that said, though, let's dive in. How can you use a reverse mortgage? There's really a few different ways that can potentially be done. Number one is that you can actually implement a reverse mortgage and not take any income out of it. So that's not a requirement. Okay. So what would that do for you? Well, imagine a scenario to where, and I use this example in our class, and I talk about, so the goal is Wendy, you're going to retire at 65 years old, just to pick an age. Okay. And one of the reasons why
30 years from now, Wendy.
Yes, you've got a long way to go. So plenty of time to get ready. So, but the goal is I'm going to retire at 65 because at that time my house is going to be paid off. And so now I've eliminated one of the largest expenses I have, and cash flow wise, I'm going to be able to make that work in my retirement. And unfortunately, 63 rolls around and you get laid off.
Oh no.
Oh,
why are you laying me off?
I'm not laying you off. I'm not laying you off. But does this happen? Sure. I promise you, everybody listening to this can think of somebody that's happened to. And now all of a sudden you're 62, 63 years old going, I haven't dusted off my resume in 15 years and I've got to go out and figure out how to get a job again for a couple more years. That is one option, and you can do that and then get yourself back on track and work towards paying your house off. But one way that we could potentially pull retirement forward would be we can get a reverse mortgage as long as you qualify, and that'll immediately stop your mortgage payment.
Yeah.
So maybe your house wasn't paid off. It's probably pretty darn close if you were only a couple years away. But what we could do is instead of waiting to officially pay it off, we could implement a reverse mortgage and immediately stop your payment. So we accomplish the same goal. And now maybe that same individual that thought that they had to go figure out how to dust off their resume and figure out how to work a couple more years, they actually might be able to pull retirement forward faster than what they thought. Okay, so that's
your house doesn't have to be paid off in order to get a reverse mortgage?
That is correct. That's a good clarifying question. And so you do not have to have the house completely paid off. Okay, now you do have to be 62 or older, and you do have to have a substantial amount of equity in the home for it to really work for you. But in that example that I'm using is obviously that person was only a couple years away. So that means that they had a smaller loan balance and quite a bit of equity there. And so yeah, you don't have to wait until it's fully paid off to implement. So that's one way to use it. The other way to use it is, like Greg mentioned earlier, is that you can implement a reverse mortgage, and instead of you paying for your mortgage every single month, what it is going to do is it's going to pay you. Okay, so right now, think of your mortgage payment, and let's say you're paying $2,500 a month in the form of a mortgage payment. What the bank is going to do is they're going to look at your age and how much equity you have, life expectancy, interest rates, all of those things come into play. And they're going to calculate, okay, based on where you're at today and all of these metrics that you qualify for, we're going to now send you, and I'll use a generic example, is maybe we're going to send you $1,500 a month or $2,000 a month now to you. Instead of you paying a mortgage, we're going to pay you, and that's going to come directly out of the equity of your home. And because it comes from the equity of your home and it actually is increasing your loan balance over time, what happens is that money is completely tax-free to you. So you do not pay any tax on that. You also don't have a corresponding payment to pay back to the bank like you did with a home equity line of credit. So if you borrow from a home equity line of credit, remember you created a new payment for yourself because the bank's expecting to be paid back. With a reverse mortgage, even though they're paying you, they do not expect to be paid back. The way that they get paid back is you pass away, you sell the home, and the equity pays off the loan balance that was created by those payment income streams. Okay. And so there's a couple ways right there that you can use a reverse mortgage in a retirement plan to be able to help you, whether it's in a strategic need of being able to pull retirement forward, or you implement this at some point in time in your life to create a tax-free income stream for yourself. And so sometimes I look at this and say, you know what, we kind of have a Roth IRA on steroids if we're wanting to utilize our home for an income source later down the road in your life. The other way that this can be used is that, it can be certainly used earlier on in a retirement plan. But I also could say is that maybe you just want that ace up your sleeve, right? Is that what it will do is allow us to comfortably spend some of your assets earlier on in the plan. And we like to pull income forward, especially in the first 10 or 15 years of retirement, because that's when you're going to be doing the most. You're going to have the most energy, your health, your time. And so how can we comfortably pull some of your spending forward? But if for whatever reason you start to run out of maybe your portfolio assets and some of the income that you're generating from your portfolio, your ace up your sleeve becomes, okay, by that point, we have our house probably paid off completely, and I can always tap into the equity of a home through the reverse mortgage. All of that has to be very strategically planned out. Okay. That's not something that you just want to kind of do loosey-goosey. You want to have that really well thought out and planned for in retirement, but it can be a massive differentiator if we just learn how to use the equity in our home properly in a retirement plan.
Yeah, a couple things to add to that, Nate, is just because you are getting a payment from your home does not mean that your taxes and insurance go away.
That's a good point. Yeah. You still got to make those payments.
And those go up over time, so you still have that payment, but your principal and interest payment goes away. I'll give you a practical example of using this in a proactive way to improve somebody's retirement and truly make it extraordinary. So let's say you're working with somebody and they have a home that's worth $500,000. They want to retire in, let's say, 5 years. And we run all the analysis and things, and the probability of success is maybe only like 50% that they're going to be able to spend the money they want to spend after retiring in 5 years and live to their full life expectancy. But if they don't want to leave the entire value of their home, say, to their kids, if they're okay tapping into a portion of that, we can put into the plan, say at age 75, let's add a $2,000 a month tax-free income stream. What's the effect of that? Well, all of a sudden the probability of success goes up to the point where, wow, I actually, instead of being 50%, I'm at 82%. It's amazing what that income stream does later on in the plan. Another approach would be, let's say somebody is at a higher probability of success of retiring in 5 years, but they're also willing to tap into the value of their home at age 75. Well, now all of a sudden, instead of being able to retire in 5 years, they can retire in 1 year. All right? They can actually get out of the rat race sooner because we're proactively creating an income stream from the equity in their home at a future date within the financial plan.
Right.
That's always super exciting. And people don't think of that. I don't know what they think of the money in their home. They just think it's dead, but it's not with these various tools that we're discussing.
No, it's not for everybody, right? And so what I would encourage everybody is it's worth educating yourself about, learning about it. It does not mean you have to use it, but boy, can it be a major differentiator. And I will say these are not cheap products to get into. They are expensive. And so you've got to look at all those details, and it's important to work with qualified professionals that know and understand and specifically do reverse mortgages and a lot of them. And so it's always important to make sure you're working with the right professionals and you're getting the proper education before you ever make that type of decision. Okay. Now, moving forward, Greg, so we talked about a couple ways to use the equity in your own personal home. I want to kind of get back into what are some other ways that we can use real estate in a retirement plan besides a home equity line of credit or a reverse mortgage?
Yeah, another way to tap into the value of the money in your home in the walls is to downsize.
Yeah.
Many times people, as they approach retirement, they become empty nesters, and all of a sudden the 4-bedroom house that living on multiple levels isn't the best fit for them moving forward in retirement. Maybe they want to relocate somewhere less expensive in a smaller home to be close to the grandkids and kids and those kind of things. So you can tap into the value of your home by selling and investing in a less expensive home. Now, there are real estate transaction costs to do that. There are costs in moving costs, et cetera. So you have to consider that side of it as well. But downsizing is a common theme in addition to home equity lines of credit and reverse mortgages.
Yeah, you know what I find on that is, and I have a client that recently did that. And while there is certainly a little bit of a paradigm shift, I mean, we would all have to go through of like, okay, I'm used to having all this space and I'm used to having all my stuff, right? And so there's a kind of that purging process that you maybe have to go through to start to say, I got to get ready to downsize. That means I got to get rid of some of my stuff. But here's what is interesting that I find happens a lot of times is all of a sudden it's like, this actually feels good. I'm getting rid of a lot of the clutter. I'm cleaning things out. I'm focusing on what truly is important to me and that I want to have. And then when they get into that new location, they feel free.
Yeah.
There's this complete freeing feeling of, I don't have all these responsibilities and these things that I got to fix in this yard that I got to mow and shovel and do all this stuff. I can literally lock and leave maybe and go travel and do all the things that I want to do. And I don't have to worry about anything. And that can be an incredibly freeing and exciting period of time for somebody as well. And so it does come with pros and cons, but I see a lot of people get really excited and start to really enjoy it because they focus on, you know what I found out? Here's what really matters most. And it wasn't all my stuff, and they really like the trade-off there. So that can be a good one. I think moving forward, we already talked a little bit about rental properties. I don't think we need to, there's various different ways that can be done, but what are other ways that you can own real estate, Greg? If you don't want to own physical real estate, is there other ways that we can do that?
Yeah, you can. There's things in the investment world. Now, these are paper assets that are backed by real assets, but you're not the actual owner. And one of the biggest differences is that you don't get a lot of the tax benefits that you were talking about, Nate,
right?
Because you're not the owner of the property. You have what's the right term? You're a partner in it.
Yep.
And these products are called real estate investment trusts. Now, there are ones that are illiquid that typically you buy and you get an income stream for 10 years, and then there's some sort of liquidation event, and hopefully you get your money back plus more. But there's also tradable REITs, tradable real estate investment trusts, via exchange traded funds that you can buy in your IRA or in any other kind of investment account. They do go up and down in value. They typically pay some dividends to you, but you're participating in the real estate space without actually being the owner of the property.
Yeah. And so, pros and cons to that, I would say one of the things that we probably see, fairly often is sometimes somebody will come in and say, I've got all these investments. And by the way, I have this one right here and I can't figure out how in the world to get out of it. And that can be one of the challenges to REITs that are not tradable, is that you find yourself kind of tied up in those positions. And that's not always bad depending on what the trade-off is there, but you got to really think through that, I think, carefully long-term, and having liquidity and access to your money is to make sure that you're investing in real estate in the right way. And so at the end of the day, as we kind of wrap up here, is that there's a lot of different ways that you can be utilize real estate. And maybe going into this podcast, you're thinking, well, I'm not a real estate investor. I don't know if this podcast will apply to me, but wait a minute. Almost everybody has real estate in some way, shape, or form attached to their retirement plan. It might just be your personal home, and learning how do I use that properly in my retirement plan. And doesn't mean you have to go out and buy your own investment properties as well. But we know that there's people that have investment properties and they're trying to figure out, okay, how does this fit in the plan? And so there's multiple different ways that real estate plays an important role. And I think that it needs to be discussed in everybody's retirement plan. We can't always just focus on the stock market. There's other ways to use these assets to help you be successful in retirement, so that at the end of the day, we want you focusing on the most important thing, is that's maximizing the return on your life and doing the things that really bring value to you and fulfillment in your life.
Easy breezy, no problem at all. I got it all right here.
Good. I saw you taking a lot of notes.
All right. So if somebody does have some more questions about what you were discussing, how do they get in touch with you guys?
Best way is to go to the website, designwealthadvisors.com, or you can give us a call at the office, 720-833-7676.
All right. Sounds good. Thank you, guys. And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time.